Hello everyone. In this particular homework explanation video, we're going to go through the homework for Chapter 13, where we talked about the cash flow statement. Well, the cash flow statement, as I've promised all along, is the final financial statement that is prepared for a company for an accounting period. We've discussed in the past income statements. We've discussed the statement of retained earnings. We've discussed balance sheets. And lastly, the cash flow statement. The cash flow statement is really to explain how cash changed, the cash balance changed from the beginning of the year to the end of the year. And as we studied in the lecture for Chapter 13, there are two methods. There's one called the indirect method, and there's another method called the direct method. The only difference is in the operating section of the cash flow statement. And once again, remember, the cash flow statement has three sections: operating, investing, and financing. Real briefly, the operating activities have to deal with current operations. So we're talking about the income statement, and we're talking about the changes in the current assets and the current liabilities. The second section, the investing section, that has to deal with all of the movement of longer-term assets, like investments, like fixed assets. And last but not least, the financing section. The financing section has to deal with all of the activity with the changes in the long-term liabilities and the equity accounts. So this first brief exercise that we're going to go through as a warm-up exercise here for Chapter 13 is brief exercise 13-1. We have four situations here, and we need to decide how would this affect the cash flow statement. Does it affect operating, investing, or financing section? And lastly, is it a cash inflow or is it a cash outflow? So let's take a look at letter A. It said issued bonds for $200,000 cash. So we're the company, we're issuing bonds, and the bondholders in turn are giving us cash. So first of all, that is a cash inflow. Cash, we are receiving the cash. And because bonds is a long-term liability, this is going to be a financing activity. Letter B, purchased equipment for $150,000 cash. Well, by purchasing equipment, we are spending cash. So this is a cash outflow. And equipment is a fixed asset, which is a longer term asset. So I'm going to say this is an investing activity. Letter C, sold land costing $20,000 for $20,000 cash. So we're selling land and we're receiving cash. This is a cash inflow. And once again, just like B, land is a fixed asset, part of the property, plant, and equipment. Therefore, it's going to be an investing activity. And last but not least, letter D, we declared and paid a $50,000 cash dividend. Well, we're the company that's paying dividends to our shareholders. That's a cash outflow. And because dividends are a payout of the retained earnings, which is an equity account, we are talking about a financing activity. So that's the key here. When we're trying to figure out whether something is an operating item, an investing item, or a financing item, we need to first see how it relates to the balance sheet. Does it affect a current asset or a current liability? If so, it's an operating activity. Does it affect a long-term asset? If so, it's an investing activity. And last but not least, if it affects a long-term liability or an equity account, that is a financing activity. So operating, investing, and financing. All right, let's turn our attention to brief exercise 13-13, where it's one simple calculation. What we are trying to do using the direct method to figure out how much cash payments we made for taxes. All right, and so what is the information from the income statement as well as the balance sheet? Well, in the income statement, there's a line item that says income tax expense of $340 million. Obviously, this is a very large corporation. All right, and so they wrote a check. Well, I shouldn't say they wrote a check. They reported income tax expense in their income statement of $340 million. That is the starting point for trying to figure out how much cash outflow there was for payment of income taxes. We're going to start with that number, $340 million. That's the expense on the income statement. However, on the balance sheet, we have a liability called income taxes payable. All right, at the beginning of the year, your liability was $297 million. And at the end of the year, the liability was $522 million. All right, so what we're saying is the liability grew by, if my math is correct, that's $225 million. The receivable actually increased. The liability increased. So, if the income tax expense was $340 million, okay, but the liability actually increased to $225 million, guess what? The expense was $340 million, but because my liability increased, that means we did not yet pay the cash. Think about that logically. Forget about debits and credits for a minute. If you say to yourself, the liability has increased throughout the year, what that means is, yes, we are recording the expense throughout the year, but because the liability is growing, that means the cash is not being paid. And the opposite would also be true. If the liability is decreasing, that means we're paying down the liability. So the cash payment is actually $115 million. Once again, we start with the expense on the income statement, and then we will take into effect the change in the liability on the balance sheet. Since our liability grew $225 million from the beginning of the year to the end of the year, the growth in the liability means that there has been no cash flow at all, so we have to subtract it from the expense. That'll give us our cash payment for income taxes. And that's just a little example of the direct method for the cash flows. Indirect method is a little bit different, and we're going to see that now. Moving on to exercise 13-9. Exercise 13-9 is, in my opinion, the best homework problem in this chapter, because here what we're going to do is we're going to go through a full-blown cash flow statement. We're going to create all of it, the operating, the investing, and the financing sections. And so the result we're going to see a full-blown cash flow statement. Let me show it to you and put it on the screen. All right, so exercise 13-9, getting there. So here's the end result. You can see, wow, you're like, oh my goodness, where do all these numbers come from? Well, we're going to use the indirect method. And basically the difference between the indirect method and the direct method is only in the operating section. The investing section and the financing activity section are the same for indirect and direct. The only difference is the operating section. Okay, now with the indirect method, basically what we're doing is this. The first thing we're going to start with is the net income number. Okay, and where would we get the net income number? Well, I would imagine most of you know by now the net income number you get directly from the income statement. So let's take a look at what was given to us. The author gave us a comparative balance sheet. The balances at the end of 2014 versus 2015. So what has happened to the cash balance? It actually decreased. It went from $17,700 to $15,200. It decreased $2,500. And our objective on the cash flow statement is to explain how the cash decreased $2,500. Now it's gone up and down over the year. I mean, if you think about your own personal checking account, think about all the ins and the outs for the year. All right, we had a beginning balance at January 1st at the beginning of the year, and at December 31st you have an ending balance. Now I'm hoping the December 31st balance, and I'm sure you're hoping too, is a lot larger than the January 31st balance, but maybe not necessarily that's the case. In any event, what a cash flow statement would do would analyze all the ups and the downs in your checking account. That's basically what a cash flow statement does for a corporation. It summarizes all the ups and the downs, the increases and the decreases. Better terms would be the inflows and the outflows, cash inflows and cash outflows for the year. In this case, like I said, overall the cash balance went down $2,500, and that's what we're going to do. So in the real world, you would go to the income statement to find the net income. For purposes of this homework problem, it was given to us down here, and I'm highlighting it. Net income was $18,300. So that's going to be the first line in our indirect method cash flow statement. And so the whole objective of the operating activities is to adjust this net income, which was prepared using accrual accounting. Do you guys remember that? We have accrual-based accounting, net income. But we're going to reconcile that number to not net income, but net cash provided by the operating activities. So the first thing we're going to do is we're going to take a look at the income statement, and we're going to figure out what are all of the non-cash expenses that we reported. All right. Well, what do we see? We see accumulated depreciation. Y'all see that? The accumulated depreciation. What happened? Well, in the beginning of the year, the accumulated depreciation had a $10,000 balance. But at the end of the year, it had a $14,000 balance. That was an increase of $4,000. Now, what would increase accumulated depreciation? Well, depreciation expense would. And if you recall from our previous studies, depreciation expense is considered what we call a non-cash expense. Yes, it reduces net income by recording an expense, but no, we will never write a check made payable to Mr. Depreciation. It doesn't exist. So the net income number was reduced because of this depreciation expense. And if my objective is to reconcile the net income to the net cash flow, what we have to do is we need to increase. We need to show a positive reconciling item. Now, it's not for, in a perfect world, we would say the depreciation expense was $4,000, right? Simply the difference between the beginning and the ending accumulated depreciation. But down here we've said that, oh, by the way, we sold a piece of equipment that did have accumulated depreciation of $1,200. So we need to consider that $1,200 in addition to this $4,000 increase. All right, adding the $1,200 to the $4,000 increase to the accumulated depreciation, effectively I've backed into the depreciation expense, and that's a number that's going to be added to the net income because we're trying to get back to the cash flow. Once again, this number net income was reduced by the depreciation expense, and I'm just positively adding it back to get to cash flow. All right, next on the income statement, which would be affected in the net income number, we would record gains and losses. And one thing you have to understand is gains increase the net income. All right, and so what we're going to do for cash flow purposes is show it as a negative reconciling item, but losses reduce net income, So to reconcile to cash flow, we're going to add it back. That's what this number is, loss on disposal of equipment. Where did I get that number? Well, down here, now in the real world, we'd have an income statement. We'd be able to see what that loss was. But here we can see the income statement wasn't given to us, but we do have this other additional information that says equipment which cost $10,000 had accumulated depreciation of $1,200. Therefore, the net book value was $8,800, and we sold it for $3,300. Well, the difference of the book value of $8,800 and the cash price of $3,300, the difference is a gain or a loss. In this case, it's a loss because we sold it for $5,500 less than its book value. That loss is going to be added back. Okay, so after we take into consideration the non-cash expenses and the gains and the losses on the income statement, the next thing we do in the cash flow statement for the operating activities is take a look at the differences in our current assets and current liabilities, besides the cash, of course. The accounts receivable is a current asset. And let's take a look at what happened. The beginning of the year, it was $22,300. At the end of the year, it was $25,200. So the accounts receivable increased by, if my math is correct, that's what, $2,900? $2,900 increase. Well, if a current asset increased, the cash is the opposite effect is going to happen on the cash. So the current asset increased $2,900. So the cash is going to decrease $2,900. That's what this number is. And so that's the only current asset we have besides cash. And we have one current liability, accounts payable. Accounts payable increased for the year, just like accounts receivable did. It went from $11,100 to $14,600. It increased $3,500 from the beginning of the year to the end of the year. Well, the increase in a liability also has an increase effect on the cash flow. It works the opposite of the changes in the assets. Okay, so that $3,500 increase in the liability is also going to have a positive effect on the cash flow. Okay, so that is everything with the operating section. Now so we started with $18,300, and we take our four reconciling items total. These four numbers are $11,300 positive. Add it to the net income, which is a positive number, and you have a positive cash flow provided from operating activities. And now investing activities. As I said to you, the investing activities have everything to do with long-term assets. And so what happened with the long-term assets? Well, investments. What happened with investments? It started the year at $16,000 and it ended the year at $20,000. What would make investments increase? Well, we most likely bought some more. So if we increase the investments by $4,000, that must mean that we bought more investments. That is a cash outflow. So if we take a look at the cash flows from investing activities, purchase of investments, you see that here, negative $4,000. And last but not least, the sale of equipment. You can see equipment, it started the year with 70 and it ended the year with 60. That means we sold $10,000 worth of equipment. But that's not necessarily our cash flow. If we take a look at the detail down here, it says equipment which cost $10,000, that's the $10,000 difference here, was sold. But how much was it sold for? $3,300. That $3,300 is going to be a cash inflow. There it is, $3,300. So from investing activities, we have a positive 3,300 and a minus 4,000. That is a net total of negative 700. It's net cash not provided by, but used by. All right, whenever it's a negative cash outflow, we say used by. If it's a positive number, we're going to say it's provided by. And last but not least, let's take it. So now we're done with the assets, the fixed assets. All right, and now we're done with the current liabilities. Now the financing activities. We got to deal with these three accounts here: the long-term liability and the equity accounts. So let's take a look at the long-term liability. Bonds payable. Now, bonds payable started the year at $30,000 and it ended the year at $10,000. Now, without any other additional information given to us, how can bonds payable decrease $20,000? Well, I guess if the liability decreased $20,000, we must have paid it off. That is a cash outflow. And that's what this number is here. Let me highlight it. Retirement of bonds. We're underneath the financing activities now. Negative 20,000. Okay. All right. So that takes care of that one. Now let's take a look at common stock. It started the year at 45,000, but it ended the year at 50,000. Excuse me. An increase of $5,000. Well, how does a common stock account increase? Typically, it increases because new owners invested in the company. That is a cash inflow. Here it is. Issuance of common stock. Positive $5,000. And last but not least, retained earnings. Now, retained earnings increased. It was $29,900 at the beginning of the year. And it was $31,800 at the end of the year. So it increased a total of $1,900. All right, how does retained earnings increase and decrease? Well, it increases with net income, but it'll decrease with dividends. And so here, this explains the $1,900 increase. Net income of $18,300. And paid dividends of $16,400. Well, we already took into consideration the net income when we put together the operating activity section. But the financing activity section, we are interested in this dividend payment of $16,400. That is going to be a cash outflow. We're actually paying dividends. All right, and so when we add up our three financing activities, it is a large negative number. Net cash not provided by, but net cash used by financing activities. So let's add up the three sections now. Net cash provided by operating activities, positive $29,600. Net cash used by investing activities, negative $700. Net cash used by financing activities, negative $31,400. If you add these three numbers up that I just read, it comes to a net decrease in cash of $2,500. And remember what we said earlier on the balance sheet. Cash at the beginning of the year was $17,700. So we'll take that $17,700 and then subtract the $2,500 decrease, and you get ending cash, $15,200. And that's going to agree with our ending balance sheet. And there it is, $15,200. So effectively, as I said, that cash flow statement has thoroughly explained how the cash balance went from $17,700 at the beginning of the year to $15,200 at the end of the year. A $2,500 decrease, and there it is. As I said a few moments ago before we started this exercise, I think this is probably the most comprehensive of all of the homework problems that you were given in this particular chapter. And this is an indirect method cash flow statement. All right, now let's take a look at exercise 13-12. Exercise 13-12, we are going to prepare the operating section only using the direct method. And so the author has made it kind of easy on us in the fact that we don't need to figure out these numbers. The author has just given us these numbers, and we need to decide. You see in brackets here, this is very important. It says not all the items are going to be used. Now remember what operating items are. Operating activities are anything dealing with current operations. So we're talking about current assets, current liabilities, current income statement activity, if you will. We're not talking about long-term assets and long-term liabilities and equity transactions. So, as an example, payment of interest. That's a current operating activity, and that would be a cash outflow. So if we come to exercise 13-12, all right, I went too fast. So we talked about, what did we just say? I forgot already. Paying of interest, $10,000. Where's the interest? Here it is. Cash out. You see there's two sections. We have the cash inflows here and the cash outflows here. So the $10,000 payment of interest, that's under the cash outflow section. Okay, next on our list. Cash sales. Does that sound like an operating item? You betcha. $48,000. Now, here, what does it say? Cash from customers. Does this say $48,000? No, it says $230,000. So where's the other $182,000 coming from? Well, we should have read a little bit more. Not only did we have cash sales for the current year, look at what else we had. We collected upon accounts receivable. When we collect on our receivables, that's also cash from customers. So if you add the 182 and the 48, that's where you get your $230,000 cash receipts from customers. Next on the list, receipt of dividend revenue. $18,000, that is an operating activity. That is a cash inflow. That's this number here, dividend revenue. We'll check that one off the list. Okay, next, payment of income taxes. Yeah, unfortunately, it's part of the world. We have to pay income taxes. It's part of normal operations. That will be a cash outflow, $12,000. And that's right here for income taxes, $12,000. Okay, next on the list, net income, $38,000. Well, like I said, for the indirect method cash flow statement, that would be the starting point. But with direct method, we don't need to worry about the net income. Okay, next, payment of accounts payable for merchandise. We're paying our vendors. That's part of normal operations, and that's a cash outflow, $115,000. That's this top number here. To suppliers for merchandise. Okay, next, payment for land. Land is a long-term asset. That's an investing activity. So that would not be part of the operating section. We already talked, so we'll come to the next column. We already talked about collecting of receivables. Next, we paid salaries and wages to our employees. That is part of normal everyday operations. That would be a cash outflow of $53,000. That is this next number here for salaries and wages. Next, depreciation expense. Well, as I explained when we went through the indirect method, that is something we would add back to the net income to arrive at the net cash flow, but for the direct method, that is ignored. Proceeds from sale of vehicles. Once again, vehicles is a fixed asset, a longer term asset. Therefore, this is part of the investing activity. Purchase equipment for cash, same thing. Equipment is a fixed asset. Fixed assets belong in the investing activities. Same thing with the loss on disposal of vehicles. All right, this is something that we would account in the indirect method, but not direct method. Payment of dividends. When we pay dividends, we are reducing the retained earnings. That is an equity account. That would be part of the financing activities. So not part of the operating activities. And last but not least, payment of operating expenses, $28,000. Yeah, that's part of normal operations. And there it is. That is a cash outflow. So we can see for the operating activities, the inflows are $248,000. The outflows add up to $218,000. So we have a net cash provided by operating activities, a positive $30,000. And as I said earlier, the direct method versus indirect method, the only difference is in how we prepare the operating section. The investing and the financing section are both exactly the same. All right, let's take a look at problem 13-2A. 13-2A, we have a couple of, looks like, questions here that we should ask ourselves. And the first one is, what's net income for the year? Well, remember, now normally we would just go to the income statement and we'd figure out what the net income is. But if you were given just some additional information without giving an income statement, we'd be able to figure it out. And so what I would do is I would look at the retained earnings number. The retained earnings, we can see it here. At the beginning of the year it was $250, and at the end of the year it was $300. And if there's something you remember from the course, I am sure you remembered how to roll forward the retained earnings account. Remember, the retained earnings, this is the account where all of the red accounts are closed out. Basically all the red, the revenues, the expenses, and the dividends. You remember that? R for revenues, E for expenses, D for dividends. All the red accounts are basically closed to zero, and those balances get sucked up into the retained earnings account. So let's try to figure out the red balances. Well, we don't know the revenues and the expenses, but what do we know? We know the dividends. It says here, a small stock dividend was declared and issued. The market value of the shares was $10,500, and cash dividends were $15,000. All right, so $10,000 was a stock dividend that reduced to retained earnings, cash dividends of $15,000. That also reduced retained earnings. So if we come here, we do a roll forward. Retained earnings at the beginning of the year was $250, and at the end of the year it was $300. That much we know. And we know we need to reduce retained earnings for both the cash and the stock dividends. So this is a plug number. What is going to make the roll forward work? That would be the R minus the E, the net income. And doing the math, it works out to $75,500. All right, that's really what I wanted you to get at in part A. Okay, and really that's all I wanted you to see really in this particular problem. And last but not least, problem 13-1B. In 13-1B, you can see, well, I can probably just show you here on the answer guide. What was given to us in problem 13-1B is we were given an activity, and we needed to decide whether it belonged in the operating section, the investing section, or the financing section. All right, so letter A, recording depreciation expense. Well, as we saw earlier today in one of the homework problems, depreciation expense, we are going to account for that in the operating section. It really is an add back to the net income. Same as letter B, incurring a loss. The loss, we're going to record that as an operating activity. It's got no cash flow effect, but effectively what we're doing is we're going to show it as a positive number to reconcile net income to net cash flow. Letter C, acquired a building by paying cash. That is a fixed asset. Fixed assets are accounted for as an investing activity, and that's a cash outflow. Letter D, we made a principal payment on a mortgage. A mortgage is a long-term liability. Long-term liabilities are accounted for as financing activities. And we're making a mortgage payment, so that's a cash outflow. E, we issued common stock. That is an equity account. Equity accounts are accounted for in the financing activities. By issuing common stock, that is a cash inflow. We brought on new investors. Letter F, we purchased shares of another company to be held as a long-term investment. Well, that's something we studied in the prior chapter. Investments are typically longer-term assets, and they're accounted for as investing activities. Because we are spending cash to buy that investment, it is a cash outflow. Letter G, we paid cash dividends to stockholders. Dividends is a payout of retained earnings, which is an equity account. Equity accounts are affected in the financing activities. And because this is a payout, it is a cash outflow. Letter H, we sold inventory on credit. So we sold inventory to our customers, but on credit, meaning the customer didn't pay us yet. So we've entered into a receivable. Well, inventory and receivables are both current assets. Current assets are affected in the operating activities section. Letter I, purchased inventory on credit. Once again, operating activity because it's a current asset. And last but not least, paid wages to employees. Well, when we pay wages, it's part of normal, everyday, current activities. That would be an operating activity. Clearly a cash outflow.